Welcome. Today we're diving into the tax implications of receiving dividends. If you're an investor, understanding how dividends are taxed is crucial for managing your finances and maximizing your returns. Dividends are payments made by corporations to their shareholders, often as a reward for investing in the company. But before you celebrate that extra income, it's important to know how the tax system treats these payments. In this video, we'll break down the basics, explore different types of dividends, and guide you through what you need to know to stay compliant and make informed decisions. Let's get started by understanding what dividends really are. Dividends are essentially a portion of a company's profits distributed to its shareholders. They can be paid out in cash, additional shares, or even other property. For many investors, dividends are a steady source of income, especially from well-established companies. However, not all companies pay dividends, and the amount can vary widely. It's important to recognize that receiving dividends doesn't mean you're getting free money. There are tax considerations to keep in mind. Next, let's look at the different types of dividends you might encounter. There are several types of dividends, but the two most common are qualified and ordinary or non-qualified dividends. Qualified dividends are typically taxed at a lower rate, while ordinary dividends are taxed as regular income. Some companies may also issue special dividends, which are one-time payments, or stock dividends, which provide additional shares instead of cash. Understanding the type of dividend you receive is essential, as it directly affects how much tax you'll owe. Let's explore the difference between qualified and ordinary dividends in more detail. Qualified dividends are those that meet specific requirements set by the IRS. Generally, they must be paid by U.S. corporations or qualified foreign companies, and you must have held the stock for a certain period. The big advantage: qualified dividends are taxed at the long-term capital gains rate, which is usually lower than your ordinary income tax rate. This can make a significant difference in your tax bill. Next, let's see what makes a dividend ordinary and how it's taxed differently. Ordinary dividends, sometimes called non-qualified dividends, don't meet the IRS requirements for qualified status. These dividends are taxed at your regular income tax rate, which could be higher than the rate for qualified dividends. This means that depending on your tax bracket, you might owe more in taxes on ordinary dividends. It's important to check how your dividends are classified on your tax documents, as this will impact your overall tax liability. Now let's discuss how you can identify which dividends are qualified and which are ordinary. You receive your annual tax documents, such as Form 1099 Div. You'll see dividends broken down into different categories. Qualified dividends are usually listed separately from ordinary dividends. It's important to review these forms carefully to ensure you're reporting the correct amounts. If you're unsure, your brokerage or financial advisor can help clarify which dividends are qualified and which are not. Accurate reporting is key to avoiding issues with the IRS. Next, let's look at the tax rates that apply to each type of dividend. Tax rate you pay on dividends depends on the type and your overall income. Qualified dividends are taxed at long-term capital gains rates, which are 0%, 15%, or 20% depending on your taxable income. Ordinary dividends, on the other hand, are taxed at your regular income tax rates, which can be much higher. Knowing which rate applies to your dividends can help you plan your investments and tax payments more effectively. Let's break down these rates with some examples. Imagine you're a single filer with a taxable income of $40,000. Your qualified dividends would likely be taxed at 0%. If your income is higher, say $100,000, the rate jumps to 15%. For those with very high incomes, the rate can reach 20%. Ordinary dividends, however, are taxed at your marginal tax rate, which could be as high as 37%. These differences highlight why it's important to know how your dividends are classified. Next, let's talk about the holding period requirement for qualified dividends. Benefit from the lower tax rate on qualified dividends, you must meet a holding period requirement. Generally, you need to have held the stock for more than 60 days during the 121-day period that begins 60 days before the ex-dividend date. If you sell the stock too soon, your dividends may be reclassified as ordinary, resulting in a higher tax bill. Keeping track of your holding periods is essential for tax planning. Now, let's see how dividends are reported on your tax return. It's time to file your taxes. You'll report dividends using information from Form 1099 Div. This form details the total dividends you received, separating qualified and ordinary amounts. You'll transfer these numbers to your tax return, usually on Schedule B in the main 1040 form. It's important to double-check the figures and ensure you're reporting everything accurately. Mistakes can lead to IRS notices or penalties. Next, let's discuss how foreign dividends are taxed. If you invest in foreign companies, you may receive dividends from abroad. These foreign dividends are generally taxed as ordinary income in the U.S., unless they meet the requirements for qualified status. Additionally, some foreign countries may withhold taxes on dividends before you receive them. You might be eligible for a foreign tax credit to offset some of this double taxation. It's important to keep records of any foreign taxes paid. Next, let's look at how reinvested dividends are treated for tax purposes. Many investors choose to reinvest their dividends, using them to purchase more shares instead of taking cash. However, even if you reinvest, the IRS still considers these dividends as taxable income in the year they're paid. You'll need to report the amount as if you received it in cash. Reinvesting can help grow your investment over time, but don't forget the tax implications. Next, let's discuss how dividends in retirement accounts are taxed. If you hold dividend-paying stocks in retirement accounts like IRAs or 401(k)s, the tax treatment is different. Generally, dividends earned within these accounts are not taxed immediately. Instead, taxes are deferred until you withdraw funds from the account, often during retirement. This can be a powerful way to grow your investments tax-free for many years. However, once you start taking distributions, those withdrawals may be taxed as ordinary income. Next, let's look at the impact of state taxes on dividends. In addition to federal taxes, many states also tax dividend income. The rules and rates vary widely depending on where you live. Some states fully tax dividends as ordinary income, while others may offer exclusions or lower rates. It's important to check your state's tax laws to understand your total tax liability. Don't overlook state taxes when planning your investments and estimating your after-tax return. Next, let's discuss the net investment income tax and how it affects high earners. For high-income earners, there's an additional tax to consider, the net investment income tax (NIT). This 3.8% tax applies to investment income, including dividends, if your modified adjusted gross income exceeds certain thresholds. For single filers, the threshold is $200,000. For married couples filing jointly, it's $250,000. If you're subject to this tax, it can significantly increase your overall tax bill on dividends. Next, let's look at how to minimize your tax liability on dividends. There are several strategies you can use to reduce the taxes you pay on dividends. Holding dividend-paying stocks in tax-advantaged accounts like IRAs or 401(k)s can defer or eliminate taxes. Focusing on qualified dividends, which are taxed at lower rates, is another approach. Tax loss harvesting, selling investments at a loss to offset gains, can also help lower your overall tax bill. Consulting with a tax professional can help you choose the best strategy for your situation. Next, let's discuss common mistakes investors make with dividend taxes. Investors sometimes make mistakes when it comes to dividend taxes. One common error is failing to report all dividend income, especially if you have multiple brokerage accounts. Another mistake is misunderstanding the difference between qualified and ordinary dividends, leading to incorrect tax filings. Not keeping track of holding periods can also result in higher taxes. Being aware of these pitfalls can help you avoid costly errors. Next, let's look at how dividend reinvestment plans (DRIPs) affect your taxes. Dividend reinvestment plans, or DRIPs, allow investors to automatically reinvest dividends into additional shares of stock. While this can accelerate your investment growth, it doesn't change the tax treatment. The IRS still considers reinvested dividends as taxable income in the year they're paid. You'll need to keep records of these transactions for accurate tax reporting and to calculate your cost basis when you eventually sell the shares. Next, let's talk about cost basis and why it matters. Cost basis is the original value of an investment, adjusted for things like reinvested dividends and stock splits. When you sell shares, your cost basis determines how much capital gain or loss you report. If you've reinvested dividends, each purchase increases your cost basis. Keeping accurate records is essential to avoid overpaying taxes when you sell. Many brokerages provide cost basis information, but it's wise to double-check. Next, let's discuss how mutual funds handle dividend distributions. If you invest in mutual funds, you may receive dividend distributions from the fund's holdings. These dividends are typically passed through to investors and retain their character as qualified or ordinary, depending on the underlying investments. You'll receive a Form 1099 div from the fund, detailing the amounts and types of dividends. It's important to review this form carefully and report the income correctly. Next, let's look at how dividends from real estate investment trusts (REITs) are taxed. Dividends from real estate investment trusts, or REITs, are generally taxed differently from regular corporate dividends. Most REIT dividends are considered ordinary income and do not qualify for the lower tax rates on qualified dividends. However, a portion may be classified as capital gains or return of capital, each with its own tax treatment. It's important to review your tax documents to see how your REIT dividends are categorized. Next, let's discuss how to handle dividend income if you're self-employed. If you're self-employed and invest in dividend-paying stocks, your dividend income is generally treated the same as for other investors. It's reported separately from your business income and is not subject to self-employment tax. However, you still need to report all dividend income accurately on your tax return. Keeping your investment and business records organized will make tax time much easier. Next, let's look at how dividend income can affect your eligibility for certain tax credits and deductions. Dividend income can increase your adjusted gross income (AGI), which may affect your eligibility for certain tax credits and deductions. For example, higher AGI can reduce or eliminate credits like the earned income tax credit or deductions for medical expenses. If you receive significant dividend income, it's important to consider how it might impact your overall tax situation. Planning ahead can help you avoid surprises at tax time. Next, let's discuss the importance of keeping good records for dividend income. Record keeping is essential when it comes to dividend income. Keep copies of all Forms 1099 div, brokerage statements, and records of reinvested dividends. These documents will help you accurately report your income, track your cost basis, and respond to any IRS inquiries. Organizing your records throughout the year can save you time and stress when it's time to file your taxes. Next, let's look at how to handle amended tax returns if you discover a mistake with your dividend reporting. If you discover that you made a mistake in reporting your dividend income, don't panic. You can file an amended tax return using Form 1040-X. This allows you to correct errors and avoid potential penalties or interest. Be sure to include any corrected Forms 1099 div and explain the changes clearly. It's always better to fix mistakes proactively rather than wait for the IRS to contact you. Next, let's discuss how to handle dividend income if you live abroad. If you're a U.S. citizen living abroad, you're still required to report and pay taxes on your worldwide income, including dividends. You may also face foreign withholding taxes, but you can often claim a foreign tax credit to avoid double taxation. It's important to understand both U.S. and local tax rules to stay compliant. Consulting with a tax professional who specializes in expat taxes can be very helpful. Next, let's look at how dividend income affects your estimated tax payments. If you receive significant dividend income and don't have enough tax withheld, you may need to make estimated tax payments throughout the year. This helps you avoid underpayment penalties when you file your return. The IRS provides Form 1040Es to help calculate and pay estimated taxes. Keeping track of your dividend income and planning ahead can make the process smoother. Next, let's discuss how dividend income is treated for children and dependents. Children and dependents who receive dividend income may be subject to special tax rules, known as the kiddie tax. If a child's unearned income, including dividends, exceeds a certain threshold, part of it may be taxed at the parent's tax rate. This rule is designed to prevent families from shifting investment income to children to take advantage of lower tax rates. It's important to understand these rules if you're investing for your children. Next, let's look at the impact of dividend income on financial aid. Dividend income can affect eligibility for financial aid, especially for college students. When completing the free application for Federal Student Aid (FAFSA), both parent and student investment income, including dividends, must be reported. Higher investment income can reduce the amount of aid you qualify for. If you're planning for college expenses, be sure to consider how dividend income might impact your financial aid calculation. Next, let's discuss how to handle dividend income in community property states. Community property states, income earned by either spouse during the marriage is generally considered jointly owned. This includes dividend income. When filing taxes, you may need to split dividend income equally between spouses, regardless of whose name is on the investment account. The rules can be complex, so it's wise to consult a tax professional if you live in a community property state. Next, let's look at how to handle dividend income from trusts and estate. If you receive dividends through a trust or estate, the tax treatment depends on the type of trust and how income is distributed. Beneficiaries may receive a Schedule K-1, which details their share of dividend income. This income is generally taxed similarly to dividends received directly, but there may be additional reporting requirements. It's important to review all documents carefully and consult with a tax advisor if you have questions. Next, let's discuss how dividend income can affect your Medicare premiums. Dividend income can increase your modified adjusted gross income (MAGI), which is used to determine your Medicare Part B and Part D premiums. Higher MAGI can push you into a higher premium bracket, resulting in increased healthcare costs. If you're nearing retirement or already on Medicare, it's important to consider how investment income, including dividends, might affect your premiums. Next, let's look at how to handle dividend income if you're subject to the Alternative Minimum Tax (AMT). Alternative Minimum Tax, or AMT, is a separate tax calculation that can affect high-income taxpayers. While most dividends are not treated differently under the AMT, certain investment income can trigger AMT liability. It's important to review your tax situation if you have significant investment income, including dividends, to ensure you're not caught off guard. Consulting a tax professional can help you navigate the complexities of the AMT. Next, let's discuss the importance of reviewing your tax situation annually. Reviewing your tax situation every year is a smart habit, especially if you receive dividend income. Tax laws and rates can change, and your investment portfolio may evolve over time. By staying informed and proactive, you can identify opportunities to reduce your tax liability and avoid surprises. Consider meeting with a tax advisor annually to review your dividend income, investment strategy, and any changes in tax law. Next, let's look at some resources for staying up to date on dividend tax rules. Tax rules around dividends can change from year to year. Staying informed is key to managing your investments effectively. The IRS website is a valuable resource for the latest information, and many financial news outlets provide updates on tax law changes. Subscribing to newsletters or working with a financial advisor can also help you stay ahead of the curve. Next, let's summarize the key points you should remember about the tax implications of receiving dividends. Sum up: understanding the tax implications of receiving dividends is essential for every investor. Know the difference between qualified and ordinary dividends, keep accurate records, and be aware of how dividend income affects your overall tax situation. Use tax-advantaged accounts when possible, and don't hesitate to seek professional advice if needed. Staying proactive can help you maximize your after-tax returns and avoid costly mistakes. Next, let's answer some frequently asked questions about dividend taxes. Common question is whether all dividends are taxable. In most cases, yes, dividends are considered taxable income in the year they're received, even if you reinvest them. The only exceptions are dividends earned in tax-advantaged accounts, like Roth IRAs, where they may be tax-free. Always check your account type and consult your tax documents to determine your tax liability. Next, let's answer another frequently asked question about reporting foreign dividends. If you receive dividends from foreign companies, you must report them on your U.S. tax return. You may also be eligible for a foreign tax credit if foreign taxes were withheld. Be sure to keep documentation of any foreign taxes paid and consult IRS instructions for claiming the credit. Accurate reporting is essential to avoid double taxation and IRS issues. Next, let's answer a question about dividend income and Social Security benefit. Dividend income can affect the taxation of your Social Security benefits. If your combined income, which includes dividends, exceeds certain thresholds, a portion of your Social Security benefits may become taxable. It's important to consider all sources of income when planning for retirement and estimating your tax liability. Next, let's answer a question about dividend income and estimated tax payment. If you receive substantial dividend income and don't have enough tax withheld, you may need to make estimated tax payments. This helps avoid underpayment penalties at tax time. Use IRS Form 1040Es to calculate and pay these taxes. Planning ahead ensures you won't face surprises when you file your return. Next, let's answer a question about dividend income and the Affordable Care Act. Dividend income can affect your eligibility for subsidies under the Affordable Care Act, ACA. Since subsidies are based on your modified adjusted gross income (MAGI), higher dividend income can reduce or eliminate your subsidy. If you rely on ACA coverage, it's important to consider how investment income impacts your health insurance costs. Next, let's answer a question about dividend income and charitable giving. You can donate dividends directly to charity, either by giving cash or transferring appreciated shares. If you donate appreciated stock, you may avoid paying capital gains tax and still receive a charitable deduction. Be sure to keep records of your donations and consult a tax advisor to maximize your tax benefits. Next, let's answer a question about dividend income and tax treaties. U.S. has tax treaties with many countries that can affect how foreign dividends are taxed. These treaties may reduce or eliminate foreign withholding taxes on dividends. It's important to review the specific treaty with the country where you invest and claim any benefits on your tax return. Consult a tax professional for guidance on international investments. Next, let's answer a question about dividend income and S corporation. S corporations generally do not pay dividends in the traditional sense. Instead, income is passed through to shareholders and taxed on their individual returns. However, if you receive distributions from an S corporation, it's important to understand how they're classified for tax purposes. Consult your tax advisor for guidance on S corporation distributions. Next, let's wrap up with a final summary and key reminders about dividend taxes. Conclusion: understanding the tax implications of receiving dividends is essential for smart investing. Always know the type of dividends you receive, keep accurate records, and stay informed about changing tax laws. Use tax-advantaged accounts when possible and don't hesitate to seek professional advice for complex situations. By staying proactive, you can minimize your tax liability and make the most of your investment income. Thanks for watching, and best of luck with your financial journey.